Good morning. My name is Denise Serwick. I'm with American United Life Insurance Company, also known as One America. We are the providers for the voluntary term life, voluntary short-term, and voluntary long-term disability programs. I'm going to talk a little bit about those each briefly today. During the re-enrollment, it is a time of year where those of you that are not currently participating in the programs can come onto the programs by completing an enrollment form and a medical questionnaire and being approved through medical underwriting. It is also a time of year for those of you that are participating in the programs, especially on the voluntary term life program, to be able to increase your coverage by the greater of $10,000 or 10%, whichever is greater. We'll go into that in more detail in just a moment. The voluntary term life program, let's talk about that first. That is life insurance. So in the event something happens to you or a dependent, a lump sum of money is paid. You're getting the buying power of all the employees throughout the company, so it brings that cost down for you. Voluntary life insurance is term insurance, so you can't borrow against it, you can't cash it in. It's strictly in the event something happens to you or a dependent, a lump sum of money is paid. Again, you're getting the buying power of all the employees, so it brings that cost down for you. On the papers that you were sent, I'll be touching briefly on these bullet points here. Number one, it is a flexible program because everyone's needs are different. Some of you may have children, some of you, your children may be growing up and out of the house. Everyone's needs are different. So you can choose as little as $10,000 of life insurance on up to the maximum on the program, which is $500,000. You are capped at 5 times your base annual earnings. So if I make $20,000 a year, 20 times 5 is 100. That would be the most that I would be eligible to apply for on the voluntary life program. Accelerated life benefit. If I'm on the program and I'm found to be terminally ill, the doctor says, Denise, you have less than a year. I can fill out a form, take it to the insurance company, and I now have 3 options available to me. I can take out 25, 50, or 75% of my benefit out early and use it for what I need to use it for. I can buy medication, pay off doctors. The remaining amount is paid to my beneficiaries. The program does include triple indemnity. What is that? That means whatever amount of life insurance you have, if death is due to an accident, that amount doubles. It triples if I'm involved in a motor vehicle accident while wearing my seatbelt. Guaranteed increase in benefit. I spoke a little bit about this earlier. Those of you that are currently participating in the program have the option to increase your current voluntary life coverage by the greater of $10,000 or 10% with no medical questions. Those of you that are eligible for that will be receiving your own personalized letter. It looks just like this, so look for that in the next few days. You simply check mark yes if you want to increase it, or no if you do not, date and sign the form. Now, for those of you that are not aware of what that provision is, it allows you the ability to increase your coverage with no medical questions every year. You don't have to take it every year. You cannot choose to increase your coverage for 3 years in a row. But then the 4th year, if you want to get that coverage increased, you can. You have that option every year, whether you take advantage of it or not, up until you hit 5 times your base annual earnings or age 70. The voluntary life program is portable as well. So if you ever leave Charles Penn Zone, you may take this coverage with you. You have a 31-day window to continue the coverage. There's a form that needs to be completed that gets sent to the company, to AUL, within 31 days from your last day worked. That form lets us know that you've left the company and that you're interested in porting the coverage, and then we communicate with you directly. We send you a quote in the mail, and then you can decide from that point if you want to move forward and port your coverage on your own and carry the program on your own. So that's the voluntary life program in a nutshell. The second page and third page of the handout that you'll be receiving is the rate page. It is based on your age as of 7/1 of 2016. So across the top are age bands, and down the left-hand side are amounts of insurance. You find the amount of insurance you're interested in, the age you are as of 7/1, and where the 2 columns intersect will show you what your biweekly deduction is. Also, for example, I'm actually going to give you an example. Let's say I want $50,000 of coverage and I'm age 39 on 7/1. For me, it's $3.32 bi-weekly. Now, 7/2, July 2nd, let's say I have a birthday and now I'm 40. I've changed into a new age bracket. My premiums will change, but not until the next July. It goes in 5-year age bands. So in my example, for 2016, I'm age 39 on 7/1. I'm going to pay that younger age band all the way through 7/1 of 2017, at which time I change to the next age bracket and I stay there for 5 years because they're in 5-year age bands. So that's how you calculate what your premium is. Now, if you take the voluntary life program on yourself, you then have 3 options to cover your spouse or children. Those 3 options are outlined for you on the handout that you'll be receiving, and the programs are mentioned right here in the center of the page. The cost is based on whether you have just a spouse you're covering, just the children you're covering, or spouse and children. Because there's so many family variations, they've made it 4-tiered rates for yourself. Spouse are covered up to their age of 70, and children are covered to age 19 or 25 if a full-time student. That's the voluntary term life program. Now we're going to switch gears a little bit. We're going to talk about the voluntary short and long-term disability program. So that's the other portion of your handout. What is disability coverage? Disability insurance coverage protects your income if you cannot work due to an injury, illness, or accident. Maternity is covered under short term as well. The 2 plans work together. Plan 1 is a short term, Plan 2 is a long term. Let's talk about those plan provisions. So as you're looking at your sheet here where it says flexibility, because again it's a group rated product and it's voluntary, so you get to decide whether or not you want to participate in the programs. Plan 1, your short term, will pay 50% of your income up to a maximum of $3,000 monthly. Okay? You become benefit eligible under the short-term disability program once you've been disabled for 15 days. Now that does include Saturday and Sunday. The short-term disability program gets its name because it covers you for a short period of time, and your short-term disability program will cover you up to a 26-week period of time. If you're disabled that long, then Plan 2 starts, your long-term disability program. It also pays 50% of your earnings to a monthly maximum of $3,000. But the long term pays up to age 65 or normal Social Security retirement age. So I'm going to hit the pause button here. So you have 2 options. You can choose just a short term, you could choose just a long term, or actually you could choose both of them for maximum protection. If you, however, only choose the long-term disability program, you need to be aware of the elimination period for the long term is 180 days. So the long term does not start paying until you've been disabled for 180 days. So you're going to need to figure out how you're going to pay your bills for the first 180 days. Am I clear on that? So for protecting that first 180 days, that's why they have the short-term disability program. So again, the short-term disability program starts paying first. Once that ends, the 26 weeks, then it begins the long-term disability, and the long-term disability will cover you to age 65 or normal Social Security retirement age. A couple of the benefit provisions under the disability, it is a tax-free benefit. Because you pay for this program with taxed dollars, Uncle Sam cannot tax you on the benefit. That's important. I'd rather pay taxes when I'm able to pay and work and earn my money, as opposed to when I can't work and now you're taxing me on my disability benefit. So it's a good provision there. Also, the program is portable. So if you leave employment, you must be insured under the disability program for 1 continuous year, and then you may take it with you for up to 1 year. So a little different than the life insurance. So you have to be insured on the plan for 1 year before you can take it with you for 1 year. Again, that same form needs to be completed within 31 days from the last day worked. That lets us know you've left. We send you the quote in the mail, and you can decide at that point if you want to move forward. How do you calculate your cost? Well, the second sheet that is also sent to you in the handout is a calculation page. If you work the math using your W-2 earnings and your age as of 7/1, the rates are down here, and then for Plan 1, again, that's a short-term plan. Plan 2 is your long-term plan. You'll be able to determine what your biweekly cost is for the disability. So we've covered a couple different provisions here. We covered life insurance, we covered short and long-term disability coverage. If you're not insured under these programs now and you would like to be under one or of the other plans, see your HR department. They will give you an enrollment form and a medical questionnaire form that is required for you to complete and return to us. That way we can do the medical underwriting for you. If approved, you'll be given a future effective date, and payroll deductions will start at that time. We are an A+ rated company. We're based out of Indianapolis, Indiana. We've been in business since 1877 with over $72 billion in assets. I appreciate your time. Thanks so much.